So we shall start. Abhishek ji, you can take it over.
Good morning and welcome everyone. A very good morning to all of you. And thanks for joining us on a Saturday morning and sharing your valuable time with us. I am grateful for your association with Trusted Arms over years and glad to share that today our asset under management has crossed 250 crores. A big thank you to all of you for trusting us with your money. People who know me knows that I mostly talk about long-term wealth creation, a wealth that can give you lifelong passive income to meet your rising expenses and lifestyle for the rest of life, for which we mainly create your portfolio using equity oriented products with some allocation in debt and gold to diversify the portfolio. Now, many people have short to medium term goals as well. And in this space, there are limited options like banks and corporate FDs, where rate of returns are typically 6 to 8% and post-tax returns is unable to beat inflation, which defeats the overall purpose of investment. Today, we will discuss about alternate fixed income investments that can give you returns between 10 to 15% and how they are able to generate such a high returns. But before that, let me tell you how I got introduced to this concept. A year back, I went to one of the seminars where I met this gentleman, Saurabh Ghosh, and we exchanged ideas about new age investment opportunities. Saurabh is a guest speaker for today and co founder of Giraffe. Giraffe is an alternate investment platform providing investment solutions like invoice discounting, commercial papers, NCDs, leasing, venture debt, and many more. And these products offer inflation beating and fixed income returns between 10 to 15%. The market for alternate investment product in India is growing at a very fast pace. It has grown from 1 lakh crore in 2017 to 7 lakh crore in 2023. These products were predominantly available in high ticket size of 1 crore and above and accessible only to HNIs and ultra HNIs. Thanks to advancement of technology, now these opportunities are available to retail investors through fintech platforms like Giraffe, starting with minimum investment of just rupees 1 lakh. Trusted Arms have joined hands with Giraffe to offer such products to its esteemed clients where we can easily invest and diversify your portfolio to get a better ROI. But before welcoming Saurabh officially, I would like to give a brief introduction about Saurabh. Saurabh is a co-founder of Giraffe and has over a decade of experience in corporate finance. He led corporate finance and strategy vertical for Ozone Group, a leading real estate developer in Bangalore and Chennai. Saurabh managed transactions of more than $1.5 billion, including structured debt, SPV purchases, asset monetization, land purchase, and much more. And he's an alumnus of IIM Ahmedabad and BITS Pilani, Goa. Thank you, Saurabh, for joining in. A very warm welcome to you. Now, I would request you to kindly take us through the various investment opportunities that Giraffe offers and how our clients can take advantage of these new age products. I would request participants, if you have any question, kindly write them in chat box and we can answer them just after Saurav's presentation. Over to you, Saurav.
Thank you so much, Abhishek. So, firstly, I would like to thank Trusted Arms, Abhishek, and then each one of you for taking out time on a Saturday morning. It's a pleasure to be here. And hopefully after this session, you will get to know something about Giraffe and something about the alternate investment in the fixed income space. I will talk about all the products that Giraffe offers and how each of these products can actually be a very important part of your financial portfolio. We work with Abhishek to take all of these products to you so that Abhishek can guide you and advise you to choose the most suitable and product for your portfolio. So he understands your portfolio well, and he will help you choose the products which works for your portfolio. Our idea at Giraffe is to provide a lot of choice to our customers, and picking and choosing the products that fit your financial portfolio. You should work along with Abhishek and the Trusted Arm teams. So with that context, let me just share my screen. I'll just use the presentation. Abhishek, if you can confirm if my screen is visible.
Yes, it's visible, Saurabh.
Great. So before I get to what is Giraffe and what do we offer, let me start just introducing who the people behind Giraffe are. Abhishek has already, given a kind introduction of me. We are two founders at Giraffe, myself and my colleague Vineet Agarwal. I'll just spend another minute about Vineet as well. He started his career in the large corporate team of Axis Bank. He used to be on the lending side. And then he was the 8th employee of Piramal Capital, their NBFC and private equity arm. When he left, he was managing $1 billion for Piramal Capital, and he was also their first employee for South India. Right? If you see this entire team, we are a team of people with each of us bringing a more than a decade of experience in financial services, and especially in debt and structured credit, which is the area in which Giraffe operates. And I think debt and structured credit is a very specialized play, and we are very happy with the kind of experience that the entire leadership of Giraffe brings. As a fintech startup ourselves, we are trying to obviously propagate technology and trying to create a disruption in the debt market, similar to what technology has done for the equity markets over the last 10 years. And as a technology startup, we are backed by some of the best investors in the country. For people who don't know Accel, so Accel Partners is one of the leading venture capital firms globally, not just in India. They're the first investors of Facebook in India. They're the first investors of urban companies, Swiggy, Flipkart, and many more. Right, so we're very happy that Accel is a part of the journey. Alongside that, we also have a lot of, I would say, well-known investors from the Indian startup ecosystem who have shown that trust and faith in us and are with us in our journey. So coming to now, what is fixed income, alternate fixed income, and why is it important now to everyone's portfolio, right? So I think one of the key things in India has been that people have been bucketing their investment into two, I would say, segments. One is the equities, and that is mostly for growth capital. And then beyond equities, everything else essentially becomes money that is in savings, fixed deposit, liquid funds, debt mutual funds, where people, as Abhishek mentioned, are earning 6 to 8%. Now, not all of this is money that is required for emergency, day-to-day use, etc. Right? So you can, and the second thing is equity markets itself is a very great asset class if you are looking at a long-term investment horizon. So I think even Abhishek touched upon this point, but in general, equity markets works great if you have a more than 3 to 5 year view with your money. Then the volatility does not impact you, and it's a very, in that sense, a stress-free investment experience. When you take a long-term view of equity markets. But the challenge is, how do I deal with my money in the short term, right? If you see the graph that on the right, India inflation rate is obviously very high. It typically hovers right now, like between 4 to 6% is what it has been. Sometimes it'll go beyond that as well. But if you're not, beating inflation with your investment products, then you're not actually creating long-term wealth for yourself. So the idea of Giraffe is to solve the problem for short to medium-term investments. When equity markets prove to be very volatile, and in the short to medium term space, you need to really diversify your portfolio so that it balances out the volatility of equity markets. And that's where fixed income products comes in. What does fixed income mean? Fixed income, I'll define it. It means a very simple thing. You get a fixed return over a fixed period of time. And because it is a fixed return over a fixed period of time, it is very predictable. So I exactly know that I will get my money back in 1 year at say 10%, or I'll get my money back in 2 years at 7%, 15%, whatever that is. So fixed deposit is an example of a fixed income product. So with Giraffe, we are trying to bring in alternate fixed income products where you are able to earn much higher returns than all the traditional options that have been there in the market. If you see the graph on the top right, these are a large variety of the investment product space. On the bottom left, there is fixed deposit savings. On the top end of it, there is crypto and angel investing as well. And then there are a lot of products in between. Public market equities is also somewhere in between. Where Giraffe operates is essentially, I would say, between public equity markets and your safe havens of fixed deposits and savings. Because this is a space where you're actually trying to get higher returns than traditional options, but at the same time, you're taking higher risks than the traditional options, but you're also taking lower risk than public market equities, right? So that's the space in between. You get higher returns than traditional investment options. You're also taking higher risk than traditional investment options, but it is lesser than what public equities offer. typically a portfolio in India is like this on the bottom left, right? It's a split between equity and conventional debt, which includes fixed deposits, debt mutual funds, savings account, etc. But all global investment studies are over the last decade suggesting a mix where alternate fixed income becomes meaningful. And most of the studies will tell you about the allocation of 10 to 20%. Why this allocation? Because as I mentioned, in the short term, it diversifies your portfolio away from equity markets. And at the same time, it is allowing you to get a higher return, a delta yield higher than your fixed deposits and savings. So your overall portfolio looks better where it is more balanced out from a volatility perspective. And also you're not taking a hit on your overall return of your portfolio, because a lot of these fixed income portfolio is actually giving you equity like returns, which you see over a long term, right? Typically in equity mutual fund, you see 12-14% kind of return over a period of time. You can earn similar returns in the fixed income space for a short to medium term investment as well, right? So that's why the typical portfolio mix includes equities, conventional debt, and maybe 10 to 20% from the alternative fixed income space. Now the question is, why Giraffe and why did we start this platform 2 years back? I think the first and foremost reason was we realized that debt, our fixed income participation in India was very low, because all the traditional products are not attractive for individual investors. They offer yields which are single digit and not inflation beating. Right. Second, we also realized that there are a lot of high quality fixed income products which are accessible to HNIs and ultra HNIs, because your IFL of the world, Kotak Wealths of the world, they are actually curating these products for the ultra HNI categories. So third, there was no tech disruption in this fixed income or debt space, similar to something that the equity markets has seen. So we kind of realized that all of these three put together, where we can actually bring products which are very attractive for individual investors. We can bring products which are earlier accessible to ultra HNIs, but now at a smaller ticket size. And we can use technology to bring these products to a wider investor audience. That's the role of Giraffe, right? And as partners and as investors, you're actually getting access to a curated or a filtered set of opportunities brought by Giraffe. And I will, explain what I mean by that. So as Giraffe, we are trying to build India's largest fixed income platform. So if you are managing your equity money or your, mutual fund money, let's say through Trusted Arms, and maybe on some other platform, we like you to manage your fixed income portfolio through Trusted Arms on Giraffe, right? And what would happen is that, Giraffe will allow you to get access to all products that you need to create a portfolio of your choice, right? Today, Abhishek can actually advise you on multiple products basis your needs of liquidity, investment horizon, risk appetite, etc. So as Giraffe, we will offer all of that choice to you. So if you see this, this is a very overall view of Giraffe. So we are a platform which essentially is offering access to fixed income products to retail investors. We work with HNIs and family offices as well. But our minimum investment size starts at 1 lakh rupees. So we are providing these same or very high quality products to a wider investor audience. How do we offer these products is the next question. And here on the other side, if you see, we work with a wide range of companies or corporates. To these companies or corporates, Giraffe is actually providing a variety of debt solution. So even companies need debt for growth and for their own day-to-day working capital. And as Giraffe, we are able to provide various kinds of these solutions to companies to raise debt. Now, why do these companies come to Giraffe? Because today the only meaningful, capital provider in the country are banks, and banks in the country have their own limitations. So these companies are also happy to work with a more flexible partner like Giraffe, where we are able to give them more structured and customized solutions. Now, all of these debt products that we offer to companies, they are packaged, structured using regulated instruments in a manner in which retail investors can directly participate. Right? As Giraffe, how do we add value? We add value because everything that you see on our platform is exclusive to us, because we are originating the transaction. What we mean by that is we actually meet the companies. We are talking to these companies. We understand their requirement. We structure the transaction. We enter into the term sheet with them. We will define the security package. We do the credit assessment. We do the due diligences. After that, we have an investment committee internally. If we like that transaction and we feel that this is a high quality company, which is of very good, I would say, strength as a business, and their capability to repay debt is extremely high, we will then bring this opportunity on our platform where individual investors can participate. As Giraffe, it is also important to understand that today there are no players in the market which are creating products for specifically individual investors. Typically, products get created in general for institutions because bulk of the money comes from institutional investors and a very small portion goes to retail investments. And what happens in that is that people are not looking at risks for individual investors specifically. There are a lot of transactions in debt where the risk is okay for institutions, but that same risk may not be okay for individual investors. So we as Giraffe are specifically curating products which are suitable for individual investor participation. And because of that, if you see, our focus is only on short and medium term investments. We don't provide anything above 3 years. Everything that we do is from 30 days to 3 years, because we feel that in this short to medium term investment space, that's where fixed income actually becomes attractive for individuals. Now, this is a it's a chart on all the products that we offer. I will just explain in a minute or two on each of these products, and then I can pick up, questions in the Q&A part of it, because I think, people will want to understand these products better. On corporate debt, essentially, corporate debt is where we are taking a balance sheet call on the company. So what we mean by that is, whether the company's operating business is strong, they are generating good profit year on year, they have good cash flows year on year, they might have collateral to give. There will definitely be identified cash flows against which we give this money. And then we also take personal guarantees, corporate guarantees, etc. So there is a lot of security structure in these products, and the company will not typically, will always be profitable and with good balance sheet strength. So this is the corporate debt space. Here, typical tenors will be 12 to 36 months. Yields will be from 8%. It can actually go up to even 16, 17%. In invoice discounting, we are actually helping companies with their working capital requirement. So working capital means typically companies also have money stuck in the trade. So, they actually incur, either they are holding inventory or they have, provided the goods and services, and they will get money back from their customers maybe after 90 days, 120 days. So a lot of money of theirs gets stuck in this working capital or their normal day-to-day business. And we are able to fund that working capital, which is a short-term investment opportunity. So here you are able to get products which are between 30 to 90 days in tenure. At the same time, it is giving you yields between 10 to 14%. Leasing is a very good asset class for us, because here we take a lot of comfort from the underlying asset. So if you are able to participate in a high quality asset, it actually de-risks the investment, because you, in this structure, you are actually owning the asset. So tomorrow, if there is a a company which for whatever reason is unable to pay, you actually have the asset which you can release it, you can sell it in the secondary market. So the control on this asset is extremely high, because you're the owner. And that's the reason we like this. And with this structure, you're also able to get 14 to 18%. The key thing is leasing is to choose the right asset. So, where the asset has a good secondary market, where the value in the secondary market is realized, and where your ownership is very well recognized. So for example, we would rather do cars where the registration certificate of the car is in your name over maybe furniture fixture, because you don't know a table and chair. How will you identify that the chair is owned by you or not, right? So typically the quality of the asset determines this product. Venture debt, we have not done many venture debt transactions because of the current environment for startups, but we've done a couple of them. Venture debt is essentially giving loan debt to companies which are either negative EBITDA, they are burning cash, typically how we understand the current startup ecosystem, right? So that is what venture debt is. Finally, I think, rather than looking at it from a product view, the idea that Giraffe is trying to build is to give you a view of portfolios. And any asset class, whether it is equity, whether it is debt, whether it is even if you are investing through mutual funds, any of these, the point is that no asset class is about a single opportunity. The asset class is always about a portfolio. So when you look at fixed income, you should not think about I am investing in company A, B, or C. You should think that I am creating a portfolio of this volume, and this portfolio is going to deliver so much return for me, right? And that's what Giraffe is trying to enable. We provide a lot of choice, right from 6% to 18%. Across every return bracket, you can see there are multiple opportunities. We work with a wide range of companies, right? And because we work with such a wide range of companies, we are able to give you this choice on the platform. And you should invest across multiple opportunities to create a portfolio that is going to work for you. And that is where Abhishek and team is going to actually help you to pick and choose those right assets and create that portfolio which is, that is working for your own investment goals and needs. But at Giraffe, if you see, like for example, we are offering you CaratLane, which was a Tata Group subsidiary, Angel Broking, Jindal Group, to even I would say well-known consumer brands like Bira, a very good, I would say, upcoming player in the fashion space like Bayumi, and a very strong, for example, a real estate provider like KNS, right? So it is a wide variety of sectors, a wide variety of names, and by picking and choosing the right assets, the right investment horizon, the right yield will help you create a portfolio in the fixed income space. And finally, as I mentioned, the underlying theme is that you should always keep diversifying and look at your returns from a portfolio perspective, and the individual product and returns are not actually meaningful. There's a lot of text here. I don't think everyone needs to read through this. But the idea to highlight over here was that at Giraffe, we spend almost 2 to 3 months in actually assessing a company and then bringing it onto a platform. As an organization, our first step is our responsibility to the individual investors who participate through Giraffe. And for us, managing and mitigating risk is the most important thing. So we have a very stringent internal credit process. Today, we work with about 45 companies in the last 2 years. To work with 45 companies, we have actually evaluated and met 500 plus companies. So out of every 10 companies we meet and evaluate, we are able to only transact with one because we feel only that one is right for individual investor participation. So we have a very rigorous process internally. Every company to transact with for the first time, it takes at least 2 to 3 months. And our conversion rates, as I mentioned here, is less than 10%. Right, so that's all I wanted to highlight. Again, we can, if there are any questions in the Q&A, please feel free to ask. As a platform, again, now we are almost 2 years old. Actually, Vineet and I, when we started Giraffe, it was June 21. So, we are almost close to 2 years old. But we are very happy to, kind of look at our own journey now over the last 2 years. As of March 23, we had more than 75,000 registered investors. As of today, in fact, we are close to having almost 1 lakh registered investors. We've done in transactions through our platform have been more than 1,300 crore. But beyond that, what has given us immense happiness is the last thing, which is till 31st March, we had actually repaid more than 700 crores to our users on the platform. And today we are at a stage, in fact, for the last 6 to 8 months, we are at a stage where every day there are multiple repayments. So a lot of money is going back to consumers on our platform. And we are also very happy to say that all the hard work and processes that we've set up is kind of yielded returns, because till date we have not had a single day delay also. So every investor has got every rupee back on the due date. But again, this is not a reflection of the future. You are getting higher returns because you are taking higher risk. There is no free lunch in the country. So, when you are participating in these transactions, it is very important to understand the underlying risks associated with it. Yes, there might be delays, there might be some defaults which might lead to some loss of capital over a long period of time. But the way you should think about it is, as I mentioned again, in a portfolio view. Today, if you invest in one stock, let's say Tata Motors, you might lose some money in a Tata Motors share, or a mutual fund might not do well for you. But overall, as a portfolio, you should look, are you making money? And similar is a thought process. That's why I said it is not about picking one opportunity. It is about diversifying. And if you diversify your portfolio well, you will see the similar double-digit returns that you see in equity markets, even in the fixed income space. So that's the way to look about it. We as Giraffe are obviously doing a lot of work to ensure that we choose the best quality of assets. And that's why we have not seen a single day delay yet. But underlying risk is something that you should always be mindful of. Again, here is something where Abhishek and team and Trusted Arm team can really help you with. Right? We are today a company headquartered in Bangalore. We have a team of 80 people, and Shantanu, who's on this call, he's a person in Kolkata, and he's the person on the ground over there. He, alongside with Abhishek, will be able to help you out with a lot of the questions and day-to-day doubts that you might have respect to our platform or any of our products. So this is it. But I've left almost half an hour of time for Q&A, and hope to see many questions, and I'll be happy to, and I'll try my best to answer them. Thank you so much.
Thank you, Saurav. Thank you for the wonderful insights related to alternate investments. And you made a very interesting point, of diversifying the portfolio, because normally what people do within fixed income space, they park most of their money either into banks or mainly into EPF or PF, and that compose around 80 to 90% of their portfolio. And of course, as we discussed, like yields are very low in these assets because of the yield going down, and during COVID period the yield was much less what it is now. And when the rate cycle turns around again, one will see range of lower interest rates.
Correct.
So it's very important to understand the different debt baskets as well, because what I've always seen, like when we deposit money into banks, we get 6.5%, but banks lend that money at the rate of 12, 13, 14, 15, 18% even. So why not understand those products well and use such kind of opportunities and platform just to earn that kind of returns.
Yeah. So Abhishek, it's an interesting analogy since you mentioned this. Typically today, a lot of, I think in India, you see a lot of places where new age companies are actually, trying to deliver maximum value to the end customer, because everywhere there are a lot of middlemen, lot of, I would say, players who eat away margin in a value chain. And a lot of startups have said, I will procure directly from the farmer and sell, this fruit and vegetable to you at the city. So you get best quality as well as the farmer makes the best price. If you think of what we do as Giraffe, it is very similar. You would actually put your money in a bank, and that bank would give it to a company at, as you mentioned, 12, 14%. As Giraffe, what we are saying is we will identify the same high quality asset to you where you can directly give it to the company. Right. So the intermediate margin that the bank was earning is something that you're directly earning. And Giraffe is actually essentially cutting out the bank in the middle. So, right. So that's actually a lot of, I would say, in startup, it is about giving the best value to the direct end customer. And that is also what Giraffe is enabling. So you started getting a lot of questions. So I will start reading the question. And
Saurabh, I have few questions, which have already come to me from investors, and then you can take all the questions related to whatever has come in the chat box. So I would like to sum up the common questions. So first of all, are these investments and products regulated?
Yeah. So there are, thank you for asking this question. So I will answer it in again an analogy, right? First is all our products are regulated, right? So you as a customer are investing in completely regulated products. Let's say, for example, today if you are investing in mutual fund as a product is regulated. Right now, when you invest in mutual fund, you have all rights, and I would say that a mutual fund investment will give you, and it protects retail investors, right? Similarly, all our products, whether it is corporate debt, inward discounting, leasing, venture debt, we are using regulated instruments. So typically we use in NCDs, which are non-convertible debentures or bonds. These NCDs will, reflect in your Demat account, which are tradable in nature. The second is if you are using invoice, then it is done through a contract, and invoices are a RBI regulated instrument which have their own regulations, which are called factoring regulation, right? So for all our instruments and products that we do, the underlying product is regulated. We follow all the given existing regulations at the product and the instrument level. Right now, the second is if you see as a platform, Giraffe as a platform, we are also bringing these products to individual investors. Right now, the question arises today is like, for example, today there are mutual fund distributors distributing mutual fund. So you can think of us as distributing regulated products. Right now, mutual fund as an association, AMFI, is a self-regulatory association. Right, it's not actually a regulated body directly by SEBI. It's a self-regulated association. So similarly, as Giraffe, today SEBI does not directly regulate the distributor. But as an end customer, you have all your rights and liabilities secured because you are investing in regulated products. So through Giraffe, whatever product you are investing in, those are regulated products. All your rights, securities that are associated with it, all of them are absolutely enforceable in a court of law. And we are following all existing norms and compliances that are there in the country for those products. Right. So there are, I would say a lot of people try to confuse people about, there are these unregulated platforms, these are new platforms. Please understand that is only related to a distribution part of the business. The products that you are participating in are completely regulated products. These same products, Kotak Wealth, IIFL Wealth used to actually take it to HNIs for the last 20 years. So we are not doing anything different. We are only reducing the ticket size and bringing it through a technology platform. So that is the way you should understand this.
Great, Saurav. Now, second question is, normally investor psychology associates high returns, especially in debt products, with high risk. So how would you define these investments in terms of risk?
Correct. Again, thank you for asking this question. First, what is the kind of risk that we take in debt product is important to understand. So the risk that we take in a debt product is what we call credit risk. And I'll explain what that is. The risk that we take in an equity product is what we call market risk, right? And you'll hear all the market risk kind of things with equities, right? So the difference in market risk and credit risk is, in market risk, a lot of there are external factors that impact your investment. So today, if there is a COVID, there is a US election, there is some financial crisis, your returns in the equity market will get impacted because you are impacted by market risk. In fixed income and in these kind of debt products, no market movement will impact your return. The only risk that you take is that I am giving money to a company or a counterparty. Will that company repay my money with the agreed interest, right? And this risk that I'm taking is called credit risk. That will the company repay my money? Now here, the challenge what India has seen is that in the past, credit rating agencies have not done a good job because, if there is a AAA rated company like DHFL defaulting, Yes Bank as a big bank is going down, typically that is what has led to loss of investor confidence because rating agencies have not done a good job in India. We as Giraffe are trying to become that, bridge that trust deficit to say that we will bring you high quality products where we are not relying on external rating agencies. That is only an input, but we are doing our own due diligences, assessments, and picking and choosing products which are right for individuals, right? The second thing is fixed return, right? So obviously there is a risk, but if you create a portfolio, typical loss ratios in these products are less than, I would say, 1%, right? You will typically see 0.2 to 0.5% default. So if you create a good portfolio across 7 to 8 investments and you keep investing over a period of, let's say, 5 to 10 years, you might see 1 or 2 investments where you lose partial amount of your capital, but at a portfolio level over 5 to 10 years, you will still make double-digit return. And that is why we keep repeating that it is not about making money in every investment. You might, it is about making money at a portfolio level for which you need to diversify well and invest consistently over a period of time. Loss ratios are less than 1%. It's typically industry average is 0.2 to 0.5%. So these events, if at all that will happen, it will be, I would say, one and few and far. And our duty is to educate all our users about all the risks so that they are aware of it. But they should also know how to actually create this portfolio and invest in this asset class, where Abhishek, you will have a good role to play. Right?
Thank you, Saurav. Saurav, one question, related to this only. Normally, I have seen, especially in Calcutta and a lot of, in other parts of India, people, what they do, they, give money to their family or friends, at a good interest rate, which is earning about 10 to 12%. And a lot of people actually have lost money there. Because, आप बोलते हैं ना कि पैसा तो जाता है, साथ में relation भी जाता है. ठीक है? And most of the money, they don't recover. So, as you mentioned, there is a possibility of, a default or a delay. So what, you do in order to, make sure that वो पैसा वापस आ जाए, आपको मिल जाए, what due diligence or, what kind of approach you have in terms of recovering that money. In case, if that you mentioned that 1%.
Yeah.
So can you just highlight on that?
Again, thank you. So just to take that analogy, people in Calcutta, like they are, lending to their friends, families, known people. I think first thing is that, two things you need to do when you give money to a company, right? First, you also need to assess the company. Typically in the lending market, we are basically lending based on trust, right? So, and trust is not a very scientific approach to, giving money. Right, it is your personal comfort. And when you lose money because there is no proper documentation, you actually have no legal right to recover that money properly. Right. So at Giraffe, we are doing two things. One is we are doing this entire diligence process. So it's a very scientific process to decide whether I should give money or not. It is not based on trust, relationship, or anything. Second is we give money to companies which have a lot to lose. Right. And what I mean by that is tomorrow, if a company defaults, they will just not default, for the sake of it. Because even if they default 1 rupee, I will first impact that company's, CIBIL score, credit score, which will impact future borrowings. Second, I will drag that company to NCLT. When I say we as Giraffe will drag that company to bankruptcy and NCLT. So, if only for the sake of not returning money, they will not return money or delay. Because if they have the capability, they better repay. Because if they don't repay, we will actually drag that company to bankruptcy court, right? So the intent to pay is always with these companies very high. If the companies have a good business, they have a strong brand, they have a reputation to protect, there is no need to default unless obviously the business is not allowing them to repay. Now, whether the business is capable to repay, that is the entire scientific approach where we are taking a call that this company is strong enough, the business is strong enough that it will always have enough money. The second part is that even when I mentioned that 1% default rate, it is actually it is across a wide variety of tenures. Means it also includes tenures of 5 years, 7 years, 9 years, because banks give money for 5, 7, 9 years as well. But we as Giraffe, you see, we only focus on short to medium term, because we know that we only give money for up to 3 years, because we know that the company's balance sheet is this today. We know how it will perform realistically over the next couple of years. I'm not taking a 5, 7 year view of the company, because then I'm actually taking equity call ki industry kaisa hoga, sector kaisa hoga. I'm not going into all of that. We are only taking a very short term view of the company. So we know that, and a very conservative view. So we are not taking too many assumptions when we see that whether the company will be able to repay or not. Right. So that makes the assessment a lot easier. Last is what your critical question is. How do I recover money? Let's say if there is that 1% default, right? That's where the documentation becomes very strong. More than 50%, other than invoice discounting as a product, all other products are highly secured. That means there will be collaterals, there will be identified cash flows, there will be personal guarantees, corporate guarantees. So the first step is we can try and recover money through all the collateral and security that we have. If that is also not possible, then we can take this company to a bankruptcy court in NCLT. In NCLT, you will be a financial creditor. So once the liquidation happens of the company, you will get whatever is you will be the first in line to get the money. As a financial creditor, when a company goes in liquidation, you are the first in the queue to get money. And if there are other financial creditors, you will get it proportionately, right? So these are all the things. So even in these 1% chances where defaults happen, it's not like it's going to be 100% loss of capital. You will recover money through collateral, you will recover money through, the bankruptcy code. It might take time, but yes, you will recover money. It's not like 100 or 0 where that one default also, if it happens, you're going to lose 100% of the capital. So that's the way to think about it.
Great, Saurabh. Thank you so much. Saurabh, now can you please answer the questions in the
Yes,
chat
I'll
box?
answer. Yes. So I'll quickly read them. What is the difference between corporate debt and venture debt? Is it only the type of companies such as startups in venture debt or something else? Yeah, so I think there are two aspects which are different. One is, as you already rightly pointed out, for us, whether startup or not, it doesn't matter. But what we say venture debt is basically giving debt to companies which are either loss making, so that means they are EBITDA negative, PAT negative, or they are cash burning companies. So then what happens is, typically the assessment is about, how much cash they will have, how much will it last them, whether they will get further equity or not. And the second difference in corporate debt and venture debt is the security structure. Typically, companies that take venture debt, they actually have no collateral to give, because yes, and you can think of a startup, we can take assets of the startup as security, but that is the realizable value of any asset of a startup is very less. They actually have nothing to give you. So typically it is a call on the business of the company itself and their ability to sustain cash and raise cash. So that is venture debt for us. It helps in a very vibrant fundraising environment. Venture debt works as a good option, because here you can make 18 to 22% return. But like I said, we have only done two. That two, last one we did was 10 months back, because the fundraising environment is not good. In corporate debt, the companies are profitable. They will be PAT profitable. They will have a lot of securities to give. They'll have personal guarantees, corporate guarantees to give. So that it is highly secured. There will be identified cash flows, and the company itself is profitable or cash generating. So that's the difference between corporate debt and venture debt. Are NRIs eligible to invest in other than invoice discounting? NRIs are not eligible to invest because these are only in public markets. NRIs are eligible to invest. So what we do is private debt market. So there NRIs are not eligible to invest, but in invoice discounting you can. But all of this has to be through your NRO account. So it will not be NRIs also, when they invest, have to invest through NRO account. It can't be through an NRI account, NRE account. What is the risk of default in this model? Is it completely safe as an FD? I already spoke with Abhishek. As I mentioned, there's a risk of default. It is not completely safe as an FD. You are getting higher returns because you're taking higher risk. But Abhishek can help you, understand that and guide you. Is there any cost involved for investors? No, there is no cost involved for investors. I'll be very transparent. The way Giraffe is earning money is because we are arranging capital for the companies as well. The companies give us a fee for arranging this capital. Whatever returns that you see on our platform, 100% of that return belongs to the investors. There is no fee over and above that. What is the downside? As I understand, you conduct due diligence, but the possibility of the company to repay the amount cannot be ruled out. So what happens when loans are not repaid by such company where money is invested? Also, rate of interest, is it simple interest or compound interest? So I think I covered, as I mentioned, yes, there is a possibility that the company may not repay, but that possibility is less than 1%. So you should diversify across many opportunities and invest over a period of time. Over 5 years, 10 years of investing, you'll see one or maybe two such events. And even in those one or two such events, you will not lose 100% of your capital. So if you invest across a portfolio, you'll still make your double-digit returns. But at an opportunity and investment level, you should be aware of the risks, because these are carrying higher risks than your fixed deposits. Rate of interest, we mention what is called IRR, which is a financial metric which helps you compare returns with products with different tenures. So for you to calculate, we also put something called a coupon on our website, which is the simple interest equivalent. These will be simple interest because we don't typically have anything accruing. So compound interest is when we are not paying out. All our investments will pay out money every month, every quarter, or on the due date. So Can you share a real life example of the scenario you just explained of taking a company to the NCLT and the result of the same? Sure. So I'll take an example. We have given money. I don't want to. Okay, let's say ABC Limited. I don't want to take any brand's name in this question. So let's say a company ABC Limited has taken money through Giraffe, and you as individual investors have participated in it. Uh, in this company, as soon as they have taken money and they have signed the legal documents, they are contractually obligated to repay that amount to you with interest, right? And they are contractually obligated to repay to you as per the agreed due date. So if the due date of the repayment is 31st May, if they don't pay you before 31st May, there is a you have the right to, in the documents that we sign, there is a right to call a default. So we can actually call a default. We will give the company maybe 7 days or 15 days time to, what we say, cure that default. So in this case, that's why there is a distinction between delay and default. So when the company is not paying on 31st May, sometimes they might pay 3 days later, 7 days later, 10 days later. So up to 15 days, there will be a time, what we call cure period, where the company can actually repay that money. That time when they repay, they will be also be paying something called a penal interest. So it is, so that it's not simple for them to delay. For them, the cost actually becomes very high if they delay. So because of the penal interest. So typically, if they have money, they will pay you back on time. But let's say for whatever reason they didn't pay you on time, there is a 15-day window they have to pay. If they pay in that along with penal interest, then well and good, you got your capital back with maybe some delay. If they don't pay in this cure period timeline, we can then actually call a proper default, where we will send notices to the company. Who will send notices? A question. So typically in all our structures, if you see in the tenured ones where there is a lot of collateral and security, all the collateral and security is in the favor of a SEBI registered trustee. So the SEBI registered trustee will send these notices to them. In case of invoice discounting, Giraffe is actually playing that role of a trustee because it's a short-term product, 90-day product. So we play that role of that trustee. So in that case, we will send a notice to the company on behalf of all the investors saying that you have defaulted. And if you don't repay now in 24 hours, we will take you to NCLT court. Let's say they don't repay in 24 hours. We can file in the NCLT, which is the National Company Law Tribunal. You can go and say that this is a company which had a debt which was due. Here are the documents which are the proof of that. The company has not repaid, and we want to admit it to what we call insolvency proceedings. So in the insolvency proceeding, the NCLT court appoints something called a resolution professional, RP, and they will then look at the company's asset and liquidate it. As a part of the liquidation, they will call other companies to bid for it. They might, if there are no bids, so if some other company bids and buys the asset, then you get the money. If no one is buying the asset, then all the assets of the company is sold off in bits and pieces. For example, I'm using a very simple example. The company has laptops; those laptops will get sold. That money will get recovered, etc. Now, whatever money gets generated through this NCLT process, the first in line is financial creditor. Because you have given a loan or a debt, you are going to get your money back first. Then is called operational creditor, which is all the vendors, suppliers if they have not paid. And third is equity shareholders. So people who are the shareholders of the company stand last in the queue, and first in the queue is the people who are giving them debt or loan. So typically, even if the company goes at 20, 30, 40% of the value, as financial creditors, you will get some money back depending on how much loan and what is that value. So this is typically the process. This process takes almost a year, but NCLT and courts have defined a 365-day window to complete it. In India, because you know how the court processes are, it might take longer as well, but this is the process. So in case it goes to this extent, there will be delay, there will be default, there will be some loss of capital, but there is also still that chance that you get your money back in 12 to 18 months, right? But we don't actually rely on this scenario. As I mentioned, as Giraffe, we have to do our best to avoid these scenarios, and industry average is 0.2 to 0.5% is the probability of these events happening. Before this event happening also, there are security collaterals that which we can actually monetize. Then is in case of company where bank loan is there, do these banks give NOC for products? Absolutely. So wherever there is a bank loan, we have to, and we are creating some charge on the company where banks are also there. In either case, the banks will be giving NOC because the banks have charge over all the company's assets. So if you want to create anything, you will need to take the bank NOC. I will distinguish something when we do working capital or invoice discounting. In those cases, the banks have something called a drawing power, right? So as long as the company is within the drawing power, the banks are also okay to share the debt in some sense. I understand that to drag the company to NCLT, the outstanding amount should be more than 1 crore. So in case the amount is less than 1 crore, then what? So this is a recent thing, that amount should be more than 1 crore because a lot of small vendors used to take the companies to NCLT. But if you see in all our situations, we have not done any so it should, the outstanding amount to be 1 crore is for operational creditors firstly. For financial creditors, even if there is a 1 rupee default, you can take them to NCLT. So I'll just clarify this. This outstanding amount is if you want to drag a company to NCLT as an operational creditor. In all our transactions, we are financial creditors, so we can even drag them for 1 rupee. There is no minimum threshold over there. What documents do we get when we give money? Do we get any proof of collateral documentation? Yes. So there will be, when you give money, you sign a document which will reflect on your dashboard digitally. That will have all the details. In case of the tenor transactions, there is something that we call the debenture trustee agreement, debenture trust deed that we sign, which has all the securities. And you as a debenture holder are party to that debenture trust deed. When you invest in an opportunity, we at Giraffe will very clearly tell you this is the security package. For a very detailed reading, we also put the offer letter, which is called a PAS4 on our website. That offer letter will be a 150-page document, which will have all details about the company's financial, what is the security and collateral for this transaction, etc. So with the offer letter and with you holding the debenture in your Demat account, that is your legal proof for having basically your right over that collateral, and that right over your collateral is being maintained by a SEBI registered trustee. So this is, as I mentioned, it's a very SEBI regulated process, and the trustee is there to ensure that the SEBI process is followed. So I don't see any other questions, Abhishek.
Yes. Thank you, Saurabh, for answering all the questions. I think there is no more questions, in the chat box. We have answered them all. What I can tell, all the participants here, that I have sent the link on chat. I will also share on personal WhatsApp. So what you can do, you can just sign up your account. It's free of cost, and you can start getting the updates regularly on WhatsApp related to whatever opportunities that are available related to invoice discounting or be it, NCDs. So all these information are available to you on WhatsApp, and you can just go through the details and what are the kind of deals that is available, what are the investment opportunities. And these are typically very short-term opportunities, like 30 days, varies from 30 days to 90 days for most of the deals for invoice discounting. And for NCDs, it's up to, as Saurabh mentioned, it's up to 3 years. So it can be a very good fit for all your short-term and medium-term requirements. And again, thank you, Saurabh, and all the participants for attending in today's webinar. I'm sure, people will adapt to these kind of investment opportunities, and we will have more such webinars in times to come to make them aware of more such opportunities. Thank you.
Thank you, Abhishek, and thank you everyone for participating. Thank you so much.
Thank you, everyone.
Thanks. Thank you, everyone.
Yeah, thank you, Shantanu.